Welcome to Halftime Report. I'm Ekta Batra and with me is Sonal Bhutra as well as Mangalam Malu. While y'all were reading the headlines, I was thinking for a quiet day. There's a lot of news for our markets. So nonetheless, yes, it is definitely a quiet day of trade. It's likely to be a quiet week as well, simply because there is that Thanksgiving holiday in the US. So there's going to be less amount of data queues and, we are heading towards the end of the year. But nonetheless, sector-specific interest continues. And we've seen that through the headlines. We've seen that in terms of the PSU banking space. Look at the number of stocks which are at fresh 52-week highs from the entire PSU banking space. Canara Bank, Central Bank, Bank of India, IOB. So the interest continues within that. We have aviation data on the radar. We have TRAI data. So we have a lot of sector-specific data to reckon with and to work with today. A lot of global cues as well. Just see what happens with China in terms of the COVID cases, any kind of tightening which takes place, because they did report a death the first time since the month of May. Brent crude, which is at 2-month lows, and the US Fed minutes, which is on Wednesday. So interesting data points from the global cues, but nothing really major which is taking place.
You said nothing really major, but at the same time you said the Black Friday holiday, basically the Thanksgiving holiday, etc.
That's not happening here.
That's not happening here, but that will be an indicator to what happens to consumer spending in the US. I was just reading some reports which said that this year, an average American is expected to spend $500 on the Black Friday sale, which is 12% higher than the previous year. But in the interim, we've seen inflation higher as well. So the volume growth could not be more than 4 to 5%. And if it beats that, that means we're in for a good consumer spending.
And that might be indicative of what the Fed could do as well.
Let's see what happens, because inflation definitely something which is hurting the US market. So that consumption number is something we'll be watching out for. But for now, let's do one thing. Let's start with the first management on the show, Arvind Smart Spaces. That is the stock on our radar. The stock is up 20% year to date. In terms of quarter two operational performance, company's bookings were up 60% on a quarter-on-quarter basis, although their collections declined year on year, that is in the first half. Kamal Singhal, the MD and CEO at the company, is joining us now to discuss the real estate demand, the outlook for their company as well. Mr. Singhal, good afternoon. Thanks a lot for joining us. Well, quarter two bookings for you, they have seen an increase both on a YY and on a quarter-on-quarter basis. Can you tell us whether this run rate will continue for you at that 245 crore rupees is what you saw in the first half? Will you be able to see that in the second half as well? And what volumes are you targeting? Because you've not given us the volume number. What did those bookings come at in terms of volumes?
Sure. So as you said, we saw a very fair amount of traction in our volume and value in terms of fresh booking this year, both during the quarter and for the half one of this year. And we are very confident that the momentum will continue. In fact, we should be ending the year with a fairly strong note. SDFC platform, as you know, has really taken shape. We've started acquiring projects, and in fact, we have started launching projects. Last quarter, we launched one project under the platform, which is platform 2, by the way, under SDFC, and that has been taken very, very well by the market. We are right now on the verge of launching second project under the platform, and a couple of more such projects are already lined up. So all in all, the pipeline of the new project is very strong under the platform and otherwise, and these launches are going to be hitting the market in the next couple of months, 3 months time, and we're very hopeful that this momentum will continue. Volumes wise, yes, normally the guidance does not include volume. Values are there to be read in the numbers already, and idea is to grow from wherever we left last year and the first 2 quarters, and we are fairly confident at that.
Mr. Singhal, I'm asking you that number because it gives us a sense of realizations, right? What realizations, average realizations, are you selling those houses at? So when you say expectation is of a strong second half, will you be able to do better than that? Are you targeting sales of, say, upwards of 1,200 crore rupees in FY23? And just a quarterly run rate in terms of volumes, how much is it?
Sure. I mean, we definitely would like to do better than what we've done in the first half, for sure. Last year, if you recollect, the fresh sales were in the region of 600 odd crores, and we have been historically growing at a rate of around 30 to 40% over previous years. And we are hopeful and trying and putting all efforts, sorry, to ensure that we maintain this momentum and growth rate. So a 30% growth rate should take us from 600 crores to the number that it comes out like. Exact number 1200 I can't say right now, but we should be able to maintain our growth in the same trajectory that we have been doing in the last few years.
Right.
Okay.
You know, I was looking at your shareholding pattern and the deal that you entered with HDFC Capital Affordable Real Estate Fund out there. They hold about 8.9% stake in the company. Can you tell us what their tenor of holding is, and is there any provision for them to increase their holding of the same?
So HDFC has been involved in three ways with the company. First, they had a platform arrangement with us, which was pre-pandemic. That platform is over, and we've invested that money into the projects already. Then came the second arrangement, which was they picking up a stake in the parent company, which is Arvind Smart Spaces Limited, to the extent of around 8.8%. Now, this obviously is a long-term capital, and this is an equity infusion. So obviously, it is a patient long-term capital, and there is no provision as such or plan as such to increase this stake from here onwards. Future is future, we can't say, but as of now, there is no arrangement like that. Now we're into the third arrangement, where this third platform has been signed with them, which is totaling to about 900 crores of investment, and which should generate something about 5,000 crores of top line for the company in terms of new projects. Investment under this platform has now started. A couple of projects are already taken and they have hit the market. And we've started seeing the results getting reflected in the numbers right now and in times to come. So these are the three independent arrangements that we've had with HDFC so far in the last couple of years.
Okay. Can you give us an overall sense, Mr. Singhal, in terms of what the demand is looking like? Because you have indicated that, you know, you are quite gung-ho in terms of the projects that you are launching. Bangalore, Pune turn out to be big focus markets for you. But what is demand looking like? What do you envisage in terms of bookings and collections for these projects?
So, I mean, I think the momentum continues fairly strongly. I mean, generally, real estate has seen a great amount of momentum post-pandemic, and we've seen the same. We've seen some great traction in everything that we've launched in the last 3-4 quarters. Of course, Bangalore is doing great, and we are on the verge of launching. In fact, as we speak, we've just about soft launched a big project near Devanahalli, Bangalore, North Bangalore, actually. And we are seeing some very, very encouraging early trends there as well.
So
I think market is fairly stable.
When you say encouraging early trends, what are you guiding in terms of, say, collections for probably the second half of the year? Do you have any sort of numbers you can provide us to give us a sense in terms of what demand is looking like vis-a-vis the first half?
So all I can say, I mean, guidance is something that we would normally avoid. But all I can say is that in terms of fresh sales, we should see a very healthy traction. We will maintain the growth momentum in terms of percentages that we saw last year, etc. But to give specific guidance is something that we would normally not do.
Mr. Singhal, you acquired 2 additional new projects measuring 27 acres and 18 acres each. What was the investment made here? Will you be making more investments? And considering that you have a strong pipeline in place, what will this do to your debt? Because in your presentation, you have mentioned that you can comfortably take up some debt. Right now, you're cash positive. What will debt look like?
So yeah, absolutely right. As of the quarter ending, we were negative debt. And obviously, that's not the situation which we want to continue for a very long time. We have got a headroom of investment coming from HDFC platform itself to the extent of 900 crores, out of which maybe around 200 odd has already been deployed. But we are on the verge of deploying 700 crores from there itself. And of course, debt is there to be taken. Our idea is to keep the debt at something below 1 in terms of debt equity. That means around 400 odd crores that can be raised by us within conservative limits. And that's what we have kept ourselves as a target. And this should be happening from here onwards. So this year, I see a debt level of somewhere around 200 crores coming by the end of this financial year. And thereafter, we'll see how it goes. But definitely, we'll have a debt equity which will remain conservative below 1, so to say.
All right. And final question, Mr. Singhal, you know, you are the MD and CEO of the company. Last year, a preferential issue of 7.5% equity was made to you. Just wanted to understand whether this was part of your compensation, or was it you actually putting money in the company and getting preferential equity against it? You know, just to clear the air on that one.
Oh, this is absolutely private, personal money invested into the company. Nothing to do with compensation, etc. Of course, this is an investment made. And that's the money which has flown into the company already in 2 tranches. the issue has been kind of subscribed and the process is over, and I have put in this money already into the company. The money has been received by the company.
All right, Mr. Singhal, it was a pleasure speaking with you. Thank you so much for joining us and taking us through the plans of the company going forward as well. And with that, a quick programming note: to fully commit to the cause of bridging the gender parity gap at the workforce, CNBC-TV18 is all set to lead charge with a one-of-a-kind mega initiative, Future Female Forward, the Women's Collective, presented by HSBC India. The initiative will be officially launched through an exclusive on-ground event on Friday, November 25th at the St. Regis, Mumbai, in the presence of Shireen Bhan, Managing Editor, CNBC-TV18, Mr. Hitendra Dave of HSBC India, and other women leaders of India Inc. Also in attendance will be some of the most influential voices from the business, entrepreneurship and entertainment spaces as well. So don't forget to tune into CNBC-TV18 on Friday, November 25th, 5:30 p.m. onwards. Welcome back. Still tuned into Halftime Report on CNBC-TV18, and it's time for our special segment, Unusual Mover. Vivek is tracking Paytm today. The stock is nosedived in trade on the back of selling by anchor investors following the lock-in expiry. Vivek is joining us to tell us more. Vivek, the stock is down 10%.
Well, absolutely. The pain continues as far as Paytm is concerned. And what's actually weighing in as far as the stock is concerned, like you rightly mentioned, has been the fear of the supply of shares post the expiry of the lock-in period. So now the lock-in ended on November 15, 2022, post which you've already seen a couple of block deals, important block deals. So SoftBank, which held a little over 17% stake, sold a significant chunk, and post that block deal now owns around 12.95% stake in the company. So one major shareholder exiting a significant chunk. However, there is now a 60-day lock-in as far as the shares of SoftBank is concerned in Paytm. Now, if you're talking about the share price performance itself, remember the IPO pricing was at 2,150 and the stock has now tanked over 75% since the IPO. So again, significant erosion as far as the stock price and market cap is concerned. And lastly, if you're talking about what is it that the management is saying, management continues to say give good positive commentary. They're saying they're looking forward to achieving the September 2023 target of adjusted EBITDA break-even. However, the worries of supply continue to surface as far as Paytm is concerned. Alibaba continues to hold over 31% stake, and other shareholders too right now are free to sell their shares as the lock-in has expired.
Take that point, big wealth destruction on Paytm ever since it's listed, and now that only continues as we speak at the low point of trade. In fact, at the lowest point that it has ever been ever since it's listed. That's about Paytm down over 70% from 74% from its post-listing levels. In fact, more than 75, closer to 80% from its issue price as well. Vivek, but hang in there because Nykaa is the other stock which is under pressure as well. Almost 2 crore shares changed hands in a block deal. A lot of supply coming in on that counter as well ever since the lock-in opened and bonus shares were credited.
Well, absolutely. After the opening of the lock-in, almost every day you've seen a large trade or a block trade happening as far as this particular name is concerned. So today, like we had indicated prior to market open, that there was likely to be a block deal, and we had told you that 0.65% of equity was expected to change hands, and Lighthouse India PE fund was the likely seller. So along expected lines, this particular sale has happened, and almost a 335 crore worth deal is what has actually transpired or has changed hands as far as Nykaa is concerned. Once again, here, post the expiry of the lock-in, we are actually seeing significant supply overhang, which is why you're seeing this particular stock continue to languish in the session.
Okay. All right, so that's the story on Paytm as well as Nykaa. To put it into perspective, in fact, Paytm listed just about a year ago in November of 2021, and at that time, the issue price was over 2,000 odd rupees. So just to put the journey into perspective for Paytm, currently at around 486 odd rupees. But NMDC remains in focus and is expected to be the biggest beneficiary from the rollback of export duties. Nigel is here to tell us more about this. Nigel.
Well, a few days ago, Kotak had upgraded the NMDC stock, and this time around it's Motilal's turn. They have gone ahead, upgraded the stock. They've increased their target price around 134 from around 124 earlier. Now they've tweaked their estimates a tad bit. On the volumes front, they're up estimates by around 2 to around 3%. And on the EBITDA per ton front, well, they have upped it to around 1,550 to around 1,560 rupees. Because of these two, their PAT estimates as well for the next 2 years moves up by around 11 to around 26%. A couple of factors they have highlighted. They say it's the biggest beneficiary of the government's move to roll back export duties. So that's point number one. And they say that even going ahead, you could also see them increasing their volumes. They were surprised that NMDC cut prices, in fact, in the last week by around 300 rupees, but they're expecting this to do a bit of a U-turn. And in December, they are factoring in a price hike. They also highlight that pellet prices should move up, which in turn will help iron ore pricing. Finally, they make the point that NMDC has demerged their steel business. So now the management bandwidth is solely focused on the core business, that's the iron ore business. Put all this together, Motilal Oswal, they're positive on NMDC. Back to you.
All right, Nigel, thanks a lot for that. So that's about NMDC. But the other couple of stocks which are buzzing around are GSPL and GAIL on account of the new gas tariff regimes kicking in. Sonal, what exactly does this mean and how big a positive is it?
Well, it is a big positive for all these, both these stocks. They have come off from the highs. GSPL at a point in time was up 8%. Now it's absolutely flat. It is positive for GAIL as well. Now, just to give you some perspective, these rules, they will be notified or they are applicable with effect from 18 November. These are new rules for pipeline tariffs as far as these two companies are concerned. It is a very technical document, but couple of important updates from this one. The first is that there's discontinuation of proposal to share 50% of the proposed incremental tariff revenue, and that would mean that these companies can go ahead and look for more capacity expansion because that has been under some pressure because of sharing of their revenues when tariffs increase. The second is that transmission loss is now considered versus the earlier provisions where they were not even considered in the books of accounts, and this would mean it is positive for the earnings of the company because now it will be considered as an operational expenditure, so the companies will be able to take a deduction for that. The third one is that there is gradual annual escalation in tariff which is allowed now. Earlier it would be with a break of 3 to 4 years, there would be a lump sum increase in tariffs, but now it will be on an annual basis for all these companies, and this is of course a positive for the company as well. MK says that PNGRB is looking at a reasonable rate of return on the operation of these pipelines for the companies, and channel checks are indicating that yes, all these companies are happy with the way amendments have been made. This will pave way for future expansion for all these companies, and unified tariff, that is the other big update which is expected here, is expected to be levied from 1st April 2023. Citi says that it has positive implications, of course, for both these companies, and tariff policy favors GSPL because that was the big uncertainty that this company was facing. GAIL faces earnings headwinds in the other commoditized business, be it petchem, be it LPG or the marketing segment. So now this takes care of that, and that's why they have upgraded GAIL to neutral from a sell. Target has been raised to 90 rupees per share. However, they retain their buy rating on GSPL with a target price of 335 rupees per share.
Okay, so definitely positive on the space. That's Citi, GAIL and GSPL. Upgraded GAIL and retains a buy on GSPL. Well, we need to take a short break now, but on the other side, technicals and how you should trade our markets today. Stay tuned.
Welcome back. It's that time of the day where we take stock of what's taking place around the F&O action, and just 2 days ahead of the November series expiry. It's not too different from what we watched yesterday as well, the 18,200 mark. That's where the fight between the bulls and the bears is stacked, because yesterday as well, this was the strike which was most active, the 18,200 call, a premium of close to around 97 odd rupees, and 18,200 put. That's the one that should come up for you as well. That has a premium of roughly around 50 odd rupees, 75 lakh shares written on there. The bears currently believe that this is a mark that they can support, which basically equates to around 18,150 as an important support. For option writers who write both the call as well as the put at 18,200, the combined premium at that straddle is a 150 odd rupees, which implies that they are again playing for that range of 18,050 to 18,350 on the way up on the Nifty. If the Nifty was to sustain higher above that 18,300 mark, we would see a further short covering, and that's primarily because in just the last 2 trading sessions, the FIs have written over 2 lakh short calls. So on the way up, if the market sustains, there is case for short covering. If it breaks above this range of 1850 to 18,350, at the lower level, 18,050 to 18,100 is also important from a technical standpoint, because we have the 20-day moving average, which is placed at the 18,080 mark. So that's as far as the F&O action is concerned. Currently, we're at the high point of trade. Does that tie in with the technicals as well? Sachidanand Uttekar joins in with his view. Sachi, this morning, a bunch of technical analysts said that, Nifty is in a bit of a no-trade zone because of this range that we're in, and there are more opportunities in individual stocks. Would you concur?
Absolutely, yes, Mangalam. In fact, if you look at the price action today, it is very well concealed within its previous day trading session itself. And when we look at the placement of the averages, Nifty has a good amount of support near its 20-day exponential moving average, which is placed at 18,080. So unless we don't break and sustain below that, probably we may not see any strong momentum on the lower side. Having said that, on the higher side, the placement of its 5-day exponential moving average would be critical. I think 18,280 is the headroom that we are looking at for the day. And in case if we surpass that, then probably the expiry range could shift on the higher side. When we look at Bank Nifty data as well, for the last 4 trading sessions, Bank Nifty has been absolutely flat. If you look at the resistance, it is clearly defined at 42,650. So until unless we don't see a breakout above that, we may not see any further momentum in Bank Nifty. And on the lower side, I think 42,300 or 42,360, where its 5-day exponential moving average is placed, I think that will be a very critical zone for the next couple of trading sessions. In case if Bank Nifty slips below that, then probably it will be the front runner when it comes to selling pressure. So as of now, it is a no trade zone for Nifty as well as Bank Nifty. And if you look at the trading bounce, I think Nifty could sustain this particular momentum that we have seen during the day. And once we have a breakout above 18,280, probably we may see a very strong directional momentum play.
Okay, what would the stocks be then today? And what would your call be on stocks such as Paytm as well as Nykaa? Do you have enough data to take a call on them technically?
Well, I think both the stocks are clearly in a strong bearish trend. So I would not advise any fresh long positions here or even bottom fishing. Probably, when we look at certain structures, it is better to avoid a stock when it is in a very strong bearish trend. Probably give it some more time to show signs of consolidation. And probably after that, if we have enough evidence for building any fresh longs or any pullback moves, then probably we can initiate some. But as of now, both the stock trends are weak, and we will avoid any fresh long positions there. When you look at certain pockets of strength, I think Dalmia Bharat is one particular counter which has been doing fantastic throughout this particular series. The 1700 support has been held on really well. So if you look at the expiry data, probably we may see this particular move getting extended in the coming expiry as well. So we are optimistic on Dalmia Bharat. We are expecting this particular move to extend towards 1800, 1820 eventually. So long positions should be built in Dalmia Bharat, December futures. Stop loss should be placed at 1695 and a positional target of around 1820. The second stock that has been on our radar is on the short side. IGL, if you look at the data for the last three expiries, it has been failing to sustain above the 430, 440 mark. Even today, we saw a false breakout, and after that, we have seen a substantial amount of selling pressure. So probably a mean reversion trade could play out well here. We already have an evidence of its 5 and 20-day exponential moving averages converging, which is a sign of momentum.
All right. Sachidanand, thank you so much for joining us and taking us through your technical outlook on the benchmark indices and individual names as well. Let's do one thing. We'll slip into a short break now. On the other side, Prashant Mehra of Grant Thornton will join us for a snapshot of deal activity.
Welcome back, and let's start with the Deal Tracker segment for today. And we have with us Prashant Mehra, as always, of Grant Thornton Bharat. And in fact, Grant Thornton Bharat has come up with this report on the October deal flow, and it is hugely declined. In fact, 44% down in terms of volumes and over 70% down in terms of the value of the deal. So there is a slow lane on the deal street, and Prashant will tell us more. So Prashant, we are more than halfway through in the month of November. The data has been put out for the month of October. Is the same sentiment really spilling over to this particular month as well?
Fortunately, actually, the sentiment is reversing, as it is usual when you move towards the end of the calendar year. We are seeing a lot of traction of deals coming in. November, we will see a lot of closures as well. It's already started clicking. While you mentioned that, yes, October has been one of the slowest months as far as 2022 is concerned. Having said that, if we look at a year to date and compare it to last year, we're still about 50% higher in terms of value, whereas the volume increase is meager at about 2-3%. But now that the Q2 results are out, balance sheet seem healthy, the focus, yes, is on domestic growth, but at the same time, there is an opportunity in the market which is about consolidation. There are a lot of deals which are in the pipeline. We will see a lot of closures between November and December, which we've already started seeing in November, and hopefully we'll end the year on a good note.
Right. While we are so hopeful about the year-end deal closures, which have been really going on for a very long time, Prashant, that is usual phenomena. But the volatility in the market, so much uncertainty about the economic scenario is generally not existent. So how is that going to impact the deal flow closure as well as the valuation dynamics, according to you?
Very important question, Nisha. Yes, I think in three parts. As far as the global indicators are concerned, yes, there are most of the countries are going into recession. I think UK formally declared it earlier this week. It will impact transaction flow in India as well. But I think the fact that our economic indicators continue to be very strong will make sure that not just investment is attracted into India, but also there is a lot of consolidation which happens in the market. That's one. As far as valuation is concerned, I think some sensibility will need to prevail there.
Right.
Normalization will happen, and towards the first quarter of the next year, we will probably see that happening, and again, the deal flow picking up once again.
Right. So first quarter of next year is when we are expecting a much better deal flow. But Prashant, very little time. Two important questions. One, the equity market window did open up. Some of the IPOs did happen. And also the biggest theme that we are seeing right now is also the, digital companies which listed last year having their lock-in periods being terminated and a lot of blocks taking place. How is this particular area developing? And startup IPOs, are they making any attempt at lower valuations right now?
Yeah, I think this is all part and parcel of digital and technology companies coming on the market. I don't think so. This will have a material impact as such. As far as other digital companies and startup IPOs coming in, we need to be very clear. And I think this is a post-pandemic scenario that just the top lines are not important. It's important that the companies have a business model, which is not just a revenue model. Once that is there, there is an IPO case in play. Yes, there needs to be money in the market also to be spent on an IPO. And I think once the valuation normalizations happen, these block deals have seen the light of day. Traction will continue in Q1, which is when we hope to see a lot of technology IPOs between January to March of next year.
All right, so that's the wishful thinking at the moment, see how the markets go. But finally, Prashant, very quickly, private equity flows have really, been tepid in this particular year. How are they poised? Are they finding the valuations much more attractive right now, or is it wait and watch? And which sectors are going to be more active on the deal street right now for the next 2 months?
I think private equities are probably following a wait and watch thing. My personal view is that they will continue to fund consolidations in the market, which should happen in the next couple of months. Normalization of valuation will happen. But I think what is very interesting is that some new sectors are coming up just in October. If you look at the report, education, media, entertainment, retail, consumer, financial services is black on the block. These are also some of the notable sectors in which investments are happening, besides the usual suspect, which is technology companies. So encouraging indicators, but yes, what really comes out of it is something that we will need to see in the next few months.
And what about the debt-laden companies? Do you think that distress sale, especially in the debt-laden companies, the brick and mortar, the old economy companies, is that going to reverse now with the interest rate hardening cycle? And also, on the other hand, some of the startups which have been finding it difficult now for survival because of the higher valuations, is there going to be distress sale on that front as well? Because a lot of experts are telling me that consolidation is looking quite tough.
Well, yes, I believe there will be. I wouldn't really call it distress sale. I would call it buying at the right value. those transactions will also happen. But I think we're a little past from brick and mortar and technology. Any business which is not moving with the times and is not innovative. Technology is an enabler. There are really no technology and non-technology companies. Technology is an enabler, but as far as companies continue to innovate, I think they will continue to grow. Yes, distressed sales or sales at the right value will happen. And those will be really interesting to watch out. But again, I think in the next month or two till the end of the year, we will just see closures happening, not really new deals coming in and closing.
All right, Prashant, always a pleasure speaking to you right here on CNBC TV18. So the big takeaway is that the deal flow is going to be better than October in the next few months to come. But then the big item to watch out will be the valuation mismatch between the buyer and the seller, whether that finds a consensus in a very volatile market. With that, we'll slip into a short breather, come back on the other side for more news and market action.
Welcome back. Still tuned into Halftime Report, and a lot of stocks from the broader markets which are moving around, and this takes us to our segment Inside Edge. Ease My Trip is the stock we are tracking today. It is up over 15%, now 12% in trade today. Among we spoke to the management today. What are the key takeaways from the interaction and about the stock as well?
Well, a bunch of things, it is up almost 12% in today's trading session, but it follows a 20% move that we saw yesterday as well. Why is it that the stock moved yesterday? Well, because it went X bonus as well as X split, and usually that causes a flush of activity around the stock. It's interesting why a company that listed just about a year and a half ago, went 3:1 X bonus and 2:1 X split, and this after having gone X bonus 1:1 in February 2022 already. So if you adjust for all of that, the issue price of the stock actually turns out to be just around 11 odd rupees, and that compares to the current market price of 64 odd rupees. So that's the kind of move that we've seen on the counter itself, and every incremental move has led to some sort of corporate action. So this is something that we need to monitor the rationale behind that. But as far as the management commentary is concerned, rather positive, because in the second quarter they grew 25% versus the peers who were flat. Overall market share for them is 11 to 12%. That is higher from 8 to 9% that they would talk about earlier. And market share among online travel agencies is at 22 to 24 odd percent. Going forward, competitive intensity, they believe, has decreased because of their increased market share, and as a result of which discounts would be lower as well, and that is margin accretive. Marketing expenses in the second quarter were higher only because of a 13 crore one-off, so that is something we need to monitor as well. And because seasonally the second quarter is weaker than the third and the fourth quarters, H2 will obviously be better, and they're looking at inorganic opportunities in hotels, cabs, as well as bus aggregators. So let's see whether we hear of any sort of announcement out there or not. The street is excited because of the corporate action. Let's see whether it can match the fundamental improvement in the company's prospects going forward too. In fact, we spoke with the management this morning, and this is what they had to say.
Usually there is a seasonality in travel industry, and quarter two, the quarter which passed by, is usually the weakest quarter. And if you see that, even though it's the weakest quarter, quarter one because of the summer holidays, and quarter three because of winter vacations, do much better than quarter two. However, at Ease My Trip, since we are a growing company, we actually grew our total business by more than 20% in this quarter, while our competitors saw their growth to be either flattish or slightly degrown as well. So as we are picking up the market share, the company grew. We certainly believe quarter three and quarter four should be better than quarter two. On the airspace, we're not interested in growing inorganically, since the growth is already happening organically and without spending much money on marketing. On the non-airspace, which is hotel, bus, train, holidays, cabs, these are the spaces where we're looking forward to grow inorganically, and there are plenty of good, disruptive, profitable, tech-driven, asset-light businesses. Our OTA share is somewhere around 22 to 24%. On the overall perspective, it would become around 11 to 12%.
All right, that's Ease My Trip, up 12% as we speak. This stock is doing well, but Piramal Pharma, that continues to be under pressure. Ekta big cuts there. Tell us more about that.
Well, yes, the downtrend continues for Piramal Pharma. So this is just basically highlighting all of the details with regards to Piramal in the past couple of days since it listed. Now, just to give you a history, it is the demerged pharma entity which listed on the 19th of October. So it's more than a month since it's listed as a separate entity of the Piramal Group. Now, it listed at around 200 odd rupees. The stock, as you can see, has corrected around 34% since its listing, and in fact had hit lows of around 120 25 rupees and has recovered from those levels, but around a 3 to 4% recovery. Now, the selling pressure continues because of reasons such as exclusion from the MSCI Global Standard Index. Separately, remember that it was a weak set of numbers for Piramal Pharma, which reported its numbers for the first time as a standalone entity. Revenue was up only around 9%, margins at 13%, which is lower than the other pharmaceutical industries, its peers within this space. First half also revenue was up 11%, margins were also weak. A couple of important takeaways in terms of what they told investors after the second quarter was that margins were impacted due to higher input costs as well as investments. The company, however, does expect an improved EBITDA margin in the second half versus the first half. They expect to achieve pre-COVID-19 growth rates of 15%, debt to EBITDA of around 4 to 4.5 for FY23 as well as FY24. So while the guidance remains strong for Piramal Pharma, the proof of the pudding will really be in the eating. People want to see whether or not the execution will come through when you talk about Piramal Pharma. So I think the next couple of quarters will be seen quite closely in terms of whether or not they can deliver in terms of numbers. Well, time for a break now, but on the other side, our commodity segment, Manisha Gupta, commodities editor, will be with us. Peter McGuire of XM Australia will be joining us. Stay tuned.
Welcome back. And crude is yet again making headlines. For one, it has turned into a contango. That means the current is cheaper than what we are looking at the forward months there. $80 is back in case of NYMEX there. Yesterday was a whirlwind kind of a session where we saw 5% of a discount or a decline at one point in time before the crude oil paired all of those losses, and we saw a positive closing and some buying, minor buying coming in the markets right now. Peter McGuire of XM Australia now joins us on the show to talk about what happened in the markets and what to expect in the first week of December. Peter, first of all, how vulnerable are markets to react to a news report, and that too with a volatility of around 5% there, so much so that Saudi Arabia and Russia had to, come out with statements to justify or rather rebuke them?
Well, exactly, Manisha. Good afternoon. I mean, when you see moves like that, it's just it puts a lot of fear into traders' mindsets, and you can imagine, this is a 24-hour-a-day market, and the markets move so dramatically that you just see these big price spikes, and people say short covering, people that were short would have done extremely well. Then, it goes long. So you can see how the impact of, press statements and rumour impacts the market so quickly and changes sentiment within seconds.
But, I don't know if you've read the report itself, but it has just so many cracks and so much of broken logic within that.
Well, exactly right. Yes, I scanned over it, and I mean, I see reports, and you try and understand exactly how did this happen and what was the framework behind it. But it was very, very sketchy, and just it didn't make sense from a trading perspective, and it just really showed the nervousness of Wall Street as far as energy traders, and how that all more or less moves the market so quickly and dynamically.
Oh, absolutely. But the point being that even as Russia demand is low, and that we have seen on a month-on-month basis, and especially now when the COVID cases are rising, there also is a COVID death after 6 months. Even then, it isn't really a full collapse of the markets. I mean, we still are holding around those $90 per barrel marks.
Well, exactly, Manisha. I mean, you got $80, as you just mentioned, for WTI, and you got Brent sitting at 87.5. And it's moving up. So, yes, there's every chance you're going to be back up a couple of more bucks to the upside. It's just whipsawing, and the volatility is incredible. It was only a couple of weeks back, and we were sitting at 98, and everyone's saying, well, we're ready to go to 100, 102, 104. And then seems to be that the price fell out of it. US dollar came off, and there were the other side of the market was that everyone, I think, moved to gold.
Well, they did. So, the first half of December is going to be very interesting. The first week itself, when we have the OPEC meeting on 4th December, the price caps coming in on 5th December, and then the US Fed rate meeting on 14th of December. Going event by event, which one is going to be important? I'm assuming all of them, but what are you expecting from 4th and 5th December?
Well, I'm looking for the 4th, Manisha. I just want to see, having been to many OPEC meetings and in the flesh, you sit there in Austria, in Vienna, and you just get a real idea of what's happening as far as the living organism of OPEC. I want to see what falls on the 4th, and the impact, naturally, what happens on the 5th as well. Now, as far as rate rises, I'm sitting here going maybe 50 basis points is where we blast off the mid-December. I'm not expecting a surprise to 75, but hey, who knows? It's still 3 weeks out.
Oh, well, yes. But, with the price cap coming in on 5th of December, we still don't know what level the price cap is coming in. Russia clearly has been reiterating on what reaction they would give on to this. But what does it really mean for Asian buyers, for India especially?
Well, the first part, as you just mentioned, as far as Russia, I mean, Russia may cut oil output to price cap, but the issue is it won't sell to buyers, and that's from Novak. And we all understand it that are adopting that mechanism. So if you want to adopt that, then you're not going to get Russian crude, and that's going to be a really big handbrake over this winter period. As far as India is concerned, maybe we're going to sit at this sort of number. As far as a price spike, I'm not necessarily thinking you're going to edge up that dramatically higher from here, but who knows, Manisha? The volatility is just incredible.
Oh, but it is, as you said, $10 of a move in 10 days is what we've seen in case of crude oil prices. So what's your sense, I'm believing immediately after the US Fed meeting is done, we get into that festival season and, the New Year's and Christmas, and the volumes will start to go down. I think the last trade that the industry is looking to do is the direction or reaction to the US Fed meeting. So in the next 1 month, then, what is your sense on the crude prices?
Yeah, well, Manisha, in that, I mean, we can quite easily say that everything seems to be winding down. But let me tell you, we get huge volatility traditionally over that Christmas to, say, the 5th or 6th of January. You can see $4 and $6 moves in that time frame. So I don't think we're going to be disappointed this year either. I'll go out on a limb and say maybe a couple of bucks higher from here, but there's so many different components. If we're going to see another massive freeze in that northeast as far as snowdrops in New York and the impact as far as demand for heating, then you're looking at any geopolitical concerns ratcheting up from here with Russia and Ukraine, what's going on with South Korea, or North Korea, I should say. So, Manisha, it's a hard one to pick a month out.
Okay, all right. Peter Maguire, thank you so much for joining us. And thank you, Manisha, for taking us through this discussion. Definitely crude oil, the big focus in the commodity markets. And for now, we'll take your leave in this edition of Halftime Report. Business Lunch will take all the action ahead. Stay tuned.